Good afternoon, everyone. Good morning to those of you on the West Coast. Welcome to our program today entitled Structuring Innovative Revenue Models for Nonprofits, For-Profits, Joint Ventures, and Social Enterprises. My name is Jeff Tenenbaum, Chair of the Nonprofit Organizations Practice here at the Venable Law Firm. And this is officially marks the 4-year mark during which we have conducted these monthly programs on a wide variety of nonprofit legal topics. We're pleased to have a really big crowd, perhaps I think even a record crowd of those who have joined us here for lunch today in Venable's DC offices, and perhaps a record crowd on the phone. I think we have about 350 people registered across the country for this program. So it's certainly a topic with broad interest. As you're going to see, unfortunately, it's a very broad topic that we kind of pitch the tent pretty widely on this one. Sometimes we focus things more narrowly. This one's a bit broader, so you're going to have to bear with us as there is a lot of material. Those of you in the room have a printed copy of the PowerPoint slide deck. You can see how big it is. We obviously are going to have to give short shrift to some of the slides and focus on those that we feel are more important. It also means, unfortunately, that we're not going to be able to take as many questions today as we typically do on our monthly programs, but I hope you understand that. We will stop at each of the kind of break points in the presentation to take maybe 1 or 2 questions. If you have a burning question here in the room, raise your hand, and we'll have folks in the back of the room, Camille and Shannon, walking around the microphones. Just wait for the microphone before you ask your question so those on the phone can hear it. And for those of you on the webinar, pose your questions to me using the chat feature on the webinar software. And again, my apologies that we are not going to be able to get to all of your questions, but you can always feel free to follow up with any of us, speakers or myself, afterward with any questions. Our contact information is on the last slide. A few other issues to cover. For those of you who are certified association executives in the trade and professional association community, these programs are eligible for continuing CAE education credit. Preview of our upcoming programs. We have 3 scheduled. First, on May 13th, next month, our program is entitled Managing Your Nonprofit's Facebook, Twitter, and LinkedIn Presence, Avoiding the Legal Pitfalls. On June 4th, our program is entitled Top Trends and Traps in Nonprofit Executive Compensation. We actually had the word 10 in there. I'm a big fan of top 10 lists. But as I was writing the promotional description, I was putting in a bunch of bullet points, and one of my colleagues, Matt Journey, pointed out there was more than 10 bullet points. So we took the word 10 out of the title. This is actually a program we're going to be, GuideStar is co-sponsoring this program with us, so we're going to have a much bigger online audience, probably several thousand joining us for this program, but it's a very hot topic, as I'm sure many of you know, and one that has, we have 2 terrific outside speakers coming to join us as well. And then on July 15th, yes, our programs, we do programs in the summertime in DC, and they do tend to get pretty good attendance and participation. Our program is entitled Mental Health Issues in the Nonprofit Workplace, Questions Raised by the Germanwings Air Disaster. As usual, we try to cover a wide variety of topics in these monthly programs, and all of them for the last 4 years and going forward are all recorded and available on our YouTube channel, our nonprofit YouTube channel, so feel free to download any of those and the related PowerPoint slides and handout materials at any time. The links to all of those resources are on the last slide of today's PowerPoint presentation. Now, let's talk about today's program a bit. As we were getting ready for this program, Carrie Segrest, who's to my far right, probably the newest member of our nonprofit group. She just joined us a few months ago, and we didn't waste any time in getting her up here on the podium. She had given me some resource materials to look at as we helped to think through and plan this program. And I came across something really interesting from a nonprofit attorney named Jean Takagi with predictions for the nonprofit community for 2015. So bear with me as I read a couple paragraphs. I think it's very relevant and really sets the stage nicely for what we're going to talk about here today. Nonprofits need to recognize more than ever they are operating in a broadened competitive environment for funds and supporters, and they need to determine how best to compete in light of the changing environment. For some nonprofits, collaborations with for-profits will be a key to staying relevant and creating greater impact. There's nothing new about looking to for-profits for funding, sponsorship, or opportunities for cause-related marketing, and we'll continue to see growth in such areas. But we'll also see new forms of collaboration, some of which will work well and others not so much. Social impact bonds will continue to be experimented with and evolve. Nonprofits will increasingly use for-profit subsidiaries to operate unrelated businesses, and we'll see more joint ventures between nonprofits and for-profits, including outside of the healthcare and low-income housing areas. These are exciting times full of challenges and opportunities that should not be trivialized as short-term hype. It's not just technology that's changing the world. There's so much more going on. Today's program is really, it's not going to focus on the traditional cause-related marketing and corporate sponsorships and other ways that nonprofits have and will continue to for years work with for-profits and others in the corporate world. We have covered those topics in the past, and we will in other programs. But today is going to focus on an area of practice that's really exploded for us here at Venable in our nonprofit practice, seeing all sorts of variations, very different creative, complex ways in which nonprofits are figuring out how to work with, how to partner up with, how to joint venture with, how to own in whole or in part for-profits, how to even create new for-profit, nonprofit hybrid models. This is still a very evolving area of the law. I'm sure one of the reasons why we have such a great attendance and participation in today's program. It's an area that we don't have answers for you in all of this, but there is a large body of existing law, federal tax law, nonprofit state corporate law, and a lot of other areas of law that gives us a lot to think about and analyze when we're talking about some of these new structures and ways to structure these ventures and partnerships and relationships, and hopefully we'll be able to give you a flavor for some of that here today and educate you a bit. So let me introduce our speakers, and then we can delve into this. First, to my far right, Carrie Garber-Seacrest is, like I said, our newest associate in our nonprofit group. She's really hit the ground running, been a real dynamo. Prior to joining us, she was senior program officer with the Lex Mundi Pro Bono Foundation, where she utilized a network of lawyers to provide critical pro bono legal services to the world's leading nonprofits and social entrepreneurs. Previously, she co-founded a nonprofit organization, Cambodia's Children Education Fund, which provided educational opportunities for impoverished and orphaned Cambodian students. She also taught fifth grade with Teach for America in New York City, and she continues to teach as an adjunct professor the course Leading and Counseling Nonprofit Organizations at American University's Washington College of Law. Andrew Schultz, to my immediate right, is General Counsel at Arabella Advisors. As General Counsel, Andrew manages Arabella's legal affairs and provides legal advice to the firm's leadership and staff, and ensures that the foundations and independent nonprofits that Arabella helps to manage, such as the New Venture Fund, are in compliance with the law. Prior to joining Arabella, Andrew was Executive Vice President at Foundation Source, and prior to that was Vice President of Legal and Government Relations for the Council on Foundations, where he headed its public policy department, providing oversight of the Council's legislative initiatives. That's where I first met Andrew. Carrie has also come to know Andrew for a number of years, and he is just a fountain of knowledge in this area and many other related areas, and you're really going to learn a lot from him today. And Andrew, maybe before we delve into the substance, can you give the 20-second elevator speech about Arabella Advisors? You'll do it better justice than me, and I want to make sure they know what your organization is about.
Sure. I was going to say a fountain of knowledge. Some of it's not even made up. So, yeah, Arabella and I'm both at Arabella and the New Venture Fund. Arabella is an innovative consulting organization that really works with foundations and social entrepreneurs from idea to implementation, providing traditional consulting, but also foundation and organizational management. We manage several nonprofits, 4 C3s, a couple C4s, 527, and what we really do is we help people take their idea, think creatively about the best way to achieve impact and innovation, and we do that, and it's both through the for-profit consulting firm with an impact investing team, philanthropy management team, a consulting team, and a team that's really focused on managing a variety of nonprofits. We have, last year, 2014, about $170 million and over 150 projects with literally hundreds of funders and supporters. So a very extensive nonprofit and for-profit network, and in today's theme, working together to achieve change. So,
all right, thank you, Andrew. Just one or two other logistical points. I'm going to turn it over to Carrie. Tomorrow, all of you will receive an email that contains a link to the recording of today's program, along with the handout materials and PowerPoint slides. Feel free to share that with colleagues or others who might benefit from that. And speaking of handout materials, there are a few, I think, very helpful articles contained for those of you in the room, in the back of the printed handout book that you have, and for those of you on the phone, you'll get that electronically in a PDF file tomorrow. And as I said, this program and all of the others that we do, you can find on our nonprofit YouTube channel. With that, I'm going to turn it over to Carrie to get us started. Carrie?
It's a pleasure to see you all here today and to know that there's such a great crowd out there online listening to what we're headed to today. So let's jump right in. As I said to my first class of fifth graders, I speak quickly, and that's the slowest you'll hear me talk the entire presentation. So they said, well, let's develop a way to tell you if you're talking too quickly. And so someone suggested a thumbs up or thumbs down, and somehow they voted and decided on this without my input. So I'm accustomed to seeing thumbs up or thumbs down if it's too fast or too slow. So please feel free to use that. I am trained as to
Have you ever gotten a thumbs down?
No. I have never received a thumbs down, so I like it. It's like, you're going too fast. All right. What are we doing today? Let's couch this with I love this stuff. Because I know, as someone who's worked in a nonprofit and who started a nonprofit, the thing that keeps you up at night usually, unfortunately, is your fundraising and whether or not you have the funds to continue pursuing your mission-driven activities. And the reason I love this area of law is because once you understand it and once you understand the complexities and what you can do with it, you can explore ways to generate revenue within the bounds of the law that will help you pursue that mission, which is why you got into this work in the first place. So with that, I am going to talk about some very boring tax stuff. So here's our agenda. We're going to do a quick review of federal tax exemption because what we are going to focus on here is primarily what are the federal tax implications for your tax-exempt organization when you want to start generating revenue in commercial activities. Then we're going to jump into how to structure that. So once we've mastered this tax stuff, we're going to talk what are the structures that are available, for-profit subsidiaries through joint ventures, and then we're going to wake you back up with some arguably controversial social enterprise structures, these new hybrid structures, which I'm sure a lot of you are very interested in learning about. So that's our goal for today. We will do Q&A at the end of each section, but we're going to try to limit it, as Jeff mentioned, because of the amount of material to cover, just to get you comprehending what are the structures available. So here's where we are today. We're in the nonprofit sector, but we're really going to focus down. And I apologize to those of you who don't work with C3 charities, but that's where we're going to be. So we're with nonprofit corporations that are tax exempt under Section 501C of the code, further identified not as private foundations but public charities. There's a reason for this. There is a complex set of regulations put on private foundations. If you're interested, it's Internal Revenue Code Sections 4940 through 4946 that govern how private foundations engage in business relationships. So we're focused on public charities, and I want to make sure that you understand that because there's a whole other area of law that will apply to your private foundation that we're not going to cover. All right, so let's do our quick review. This is going to be the boring tax stuff. You just had lunch, so hopefully you'll be awake through it, and then we'll get to the interesting stuff. So the code, that's where we're starting. Section 501c3 organizations must be organized and operated in furtherance of one of these purposes. We talk about this here because your activities that you're going to generate revenue from must be in furtherance of one of these activities, or you're going to do one of two things: incur unrelated business income tax, or worst case scenario, jeopardize your tax exempt status. Those are our two primary considerations the rest of the presentation. So what are those purposes? Generally speaking, religious, charitable, scientific, testing for public safety, literary or other educational purposes, and then it goes on. The code continues, though, in describing these organizations that are considered tax exempt to talk about the prohibition on private benefit and private inurement. Here, we're talking about a nonprofit tax-exempt organization may not allow its earnings to inure to the benefit of any private individual. An insider is to whom the private inurement regulations apply. That's any person having a personal or private interest in the activities of the organization. Here, there's a difference. Oop, did it go forward? Oh, man, it's going forward on its own. All right. Okay, thank you. So we're still in private inurement and private benefit for those of you who are following along on the web. Where we most often see private inurement is in the context of compensation, and I'm sure you're all very familiar with this. Show of hands in the room if you don't mind. How many of you have thought about or considered or been concerned about levels of compensation in your nonprofit and making sure that's reasonable? That is because of this area of law. So you do have familiarity with private inurement, private benefit, because any financial resources flowing from your nonprofit to a private individual will raise red flags because no one may benefit from your nonprofit other than an incidental benefit. But like I said, the best example is compensation for services performed. And the analysis here will depend on all the facts and circumstances. So good other examples other than compensation are listed here. Paying personal expenses for founders is typically not a good idea. Providing rent-free residence for the founder and his family, also something common we've seen. Or granting interest-free or no obligation to repay loans to individuals who are considered insiders.
Carrie, can I jump in for a second?
Yeah.
I just want to make sure that everyone understands the distinction between private inurement and private benefit. And just to be clear, the private inurement doctrine applies to most types of tax-exempt organizations, C3s, C4s, C5s, C6s, whereas the private benefit doctrine only applies to 501c3 organizations. But I know that many of you, the organizations that you work for or represent here in the room and on the phone, are 501c3 organizations, or perhaps your parent entity is a 501c6 or C4, but you have one or more 501c3 related foundations. So the private benefit doctrine is very important to be cognizant of. The private inurement doctrine, like Carrie just explained, only applies to insiders, officers, directors, maybe certain committee members or committee chairs, key employees and executives of the organization. And it's about making sure that they don't profit too much from their relationship with the organization. If they're an employee, making sure they don't get excessive compensation. And there is now a very kind of set in the law and set in best practice method for what you are supposed to do to help ensure that you don't violate that private inurement prescription by having a group of independent decision makers evaluate and set that compensation, having them rely on benchmarking data and other independent comparability data to ensure that the compensation is not greater than fair market, and then documenting that process contemporarily. But what a lot of folks don't understand is that the private benefit doctrine is actually much broader than that. It's much broader. Thankfully, it only applies to C3s, but it doesn't just apply to insiders. It's also not nearly as much of a, and I hate to even call the private inurement test mechanical, but compared to the private inurement test, the private benefit test is far more amorphous. It's got a qualitative component and a quantitative component. We could spend an hour just talking about the doctrine overall, but the key thing probably for you to take away is that whenever you are having some sort of a relationship between a nonprofit C3 organization and typically a for-profit or perhaps even individuals, if that for-profit or those individuals are going to benefit too much from that relationship, and it's not just about the nonprofit paying money to those individuals, it could be just that the nature of that relationship is that it enables them to profit from some other source. If there's too much benefit, if the benefit to those individuals, to that company, or to an industry, or even to, say, a 501c6 organization, materially outweighs the benefit to the public, both quantitatively and qualitatively, and the qualitative test means that it's no greater than necessary to further that exempt purpose. That's a problem, and that can violate the private benefit doctrine. The only penalty for that is loss of exempt status. This is a doctrine that we've seen the IRS really rediscover in the course of IRS examinations, audits of 501c3 organizations that we've handled many of in recent years. It's an area that they are enforcing aggressively. And so if you have, for instance, a potential partnership or joint venture with something else between a nonprofit and a for-profit, even if the nonprofit's not funneling any money to the for-profit, but the for-profit is going to profit quite handsomely from that relationship, this is a doctrine that you have to pay attention to, and that's why we're talking about it today.
Yeah, and I was just going to say, and I think that's kind of the critical touch point in all my experience. When people come in and we're talking about how to structure a joint venture, the nonprofit folks, the exempt organization folks are really focused on this is how it's going to further our mission. It's clearly got a deliverable. We're really going to change the world with this. They never look at the for-profit side. They're like, what's in it for them? And, to some extent, there needs to be something in it for them, but again, it's that constant balancing between what's our investment, what's our return, and how are we using our assets on the nonprofit side, and what are we breaking open, if you will, for the for-profit. You just have to constantly balance those things, because if it's too good of a deal, it'll break the structure. So we'll talk about that in more detail as we move in, but that's a great point.
Exactly, and as they both mentioned, the concerns that you'll hear about private benefit, you're going to get sick of hearing about because they will be in each of these sections, because this is the IRS's favorite area to deny or revoke exempt status. And as Jeff mentioned, the penalties here are steep. You lose your tax-exempt status if there's any evidence of private inurement. You may not have any. Private inurement. Private benefit, incidental is allowed in furtherance of exempt purpose. Think about, in the context of universities, students. Students receive a benefit from a tax-exempt public charity university, but it's incidental in furtherance of their purpose, if that makes sense. So loss of tax-exempt status is your penalty, and or the imposition of excise taxes on acts of inurement, and those can get pretty steep. All right.
And those excise taxes, sometimes called intermediate sanctions, are taxes that the IRS levies and can levy on the recipients of that excessive compensation. And we're seeing them do that more and more often. That's kind of how the reason why IRS asked Congress to enact those provisions in Section 4958 of the Code into law back in 1995, because the IRS only had one penalty that it could assess, and that was revocation of exempt status. Now the IRS can go after those recipients of excessive compensation and levy some pretty hefty penalties, 25% of the excess amount, and requiring that excess amount to be repaid to the nonprofit. And if that doesn't happen in short order, they can levy a 200% excise tax. And what we're seeing the IRS do more and more is pursue that route instead of pursuing revocation of exempt status, particularly in cases where it seems like the 501c3 organization was the victim of that.
Yeah.
And by the way, those excise taxes, at least right now, only apply to C3, to the beneficiaries of compensation from C3 and C4 organizations, not to 501c6 or other tax-exempt categories.
So the converse to the prohibition on private inurement and private benefit is that a nonprofit tax-exempt entity must operate in furtherance of a public benefit. So that's the flip side, which means in terms of the commerciality, you may not have more than an insubstantial amount. How do you like that for being clear and concise? That's what we're working with here. Now, in the context of Internal Revenue Code Section 501c3, as we said, an organization must be organized and operated in furtherance of XYZ exclusively for those purposes. Here, exclusively does not mean exclusively.
Yeah, I like to talk about the tax code, and my wife have a different definition of exclusive, because if I told my wife we've got an exclusive relationship, the way the IRS defines that, we'd have trouble at home. So. Because
exclusively in this context means primarily, and I would say the same thing to my husband. We do not have the same definition of exclusive as the Treasury regulations. So primarily, so as long as your organization is organized and operated primarily for one of those purposes, you're going to be okay, which leads us to the title, not more than an insubstantial amount. You're going to say to me, Carrie, well, what does that mean? Does that mean 49%? Does that mean 20%? I can't tell you because I don't know, because no one knows. I'm not even sure the IRS knows what insubstantial amount means. So let's talk more about commerciality. The IRS will revoke or deny tax-exempt status to otherwise qualifying organizations if they think that one of your activities will be more than an insubstantial amount and it's not in furtherance of your exempt purposes. In other words, will it require substantial attention from the organization? Generally, we've seen three ways that the IRS will evaluate that. How much is the income from that activity compared to the income from your other activities? How much time is spent on that activity compared to your other in furtherance of exempt activities? And how much do you spend on that? And that will inform the IRS's examination of the facts and circumstances regarding whether or not you have more than an insubstantial amount of activity that is in operation of a commercial purpose, not a public benefit. Some rulings from the IRS have said more than 30% starts to trigger problems, but I would not use that as a rule of thumb in any case because that cannot be considered precedential.
Yeah, and I was just going to add, I mean, the greatest fallacy in the world that I think is that you can do whatever you want as long as you take the proceeds and give them to charity. That is not a charitable activity. So any number of organizations have come to me and said, we're going to do this really great, fantastic commercial activity, and every penny we make, we're going to give to charity. We want to set up a charity. I'm like, you're not a charity. You're a for-profit business that's giving charitable contributions to charities. And so I think that's key because you might have an idea in this stress to raise more money. You don't want to ask, we're going to start this quasi-commercial activity. The next thing is growing gangbusters. The revenue's pouring out. And you're like, hey, this is awesome. We've got more money. And the next thing you know, it's the tail wagging the dog, and you've got a massive commercial program. And the only thing you're doing anymore, and you're subsidizing a fairly small nonprofit activity, and you're going to lose your exempt status. So it's really careful to think about what is that balance between the work we're doing and the fact that you're spending all the money to further your mission after it's said and done isn't enough. And the IRS has ruled in this over and over and over and over again.
So you can't generate a ton of money and then just say, but I need my exempt purpose is to raise money for my exempt purpose. No, we don't allow that 2 levels of justification. Which brings us to a quick history lesson. This is one of my favorite history lessons. NYU, as a university, received as a bequest a macaroni company. Many of you have heard of it, Mueller Company, in the 1950s, and was operating it at quite a profit. The for-profit competitors got quite irritated about this because here was this organization, NYU, as a tax-exempt organization operating a for-profit subsidiary, which didn't then have to pay certain amounts of taxes. And so the for-profits cried foul. It's unfair competition is what they said, and the courts agreed. So since then, we've had a prohibition on the operation of businesses, even if related to your exempt purpose, they must be taxed, is the gist of it. They had paid no income taxes, and now no longer are we allowed to operate an unrelated trade or business without it being taxed, which brings us to unrelated business income tax. So this unrelated business income, taxable income, is the gross income derived by any organization from any unrelated trade or business regularly carried on. This means you need 3 things in order to have taxable income. It needs to be a trade or business, and there are specific definitions on that. It needs to not be substantially related. Again, we're going to go into that. And it needs to be regularly carried on. If your activity fails one of these, then the revenue generated from that activity will not be unrelated business taxable income. We got this regime from the NYU case saying, all right, well, you can continue to operate if it's an insubstantial amount, a commercial enterprise, but you're going to be taxed on it so that you don't have unfair edge over for-profits doing the same thing.
And I would just be very clear about this. In passing this regime, the IRS was explicitly saying, or implicitly saying, you can have unrelated trade or business activities. As a lawyer, I'm always confounded by the fact that people, oh, well, it's you, but we can't do it. I'm like, the very structure of the tax code says you can do this, and would you rather have $1 million that you have to pay 30% tax on, or $0? That's a stupidity test. I'll take the million subject to 30% tax every time. And with some creative accounting, it may not actually be all profit. So let's get into that later. But I just think the point is, like, a lot of people hear you bet and they're like, oh, can't do it, you bet. I'm like, you can't do too much of it, but you can have some. So always think about what the balance is between that unrelated business income tax liability and the revenue you can derive from it.
And sometimes these unrelated business activities are going to be related to your purpose. There is going to be some good connection, and there can be some value in doing it. It may not pass the test where it turns into related income, tax-free income, but it's still going to be valuable, and sometimes it's completely unrelated. Sometimes you just stumble on something that's really valuable, profitable, and makes you a hell of a lot of money, and those monies can then be used to help further your exempt purpose and mission. Now, how you use the money doesn't turn it into tax-free income, but like Andrew said, you pay some tax on it. You try to reduce the net tax liability with whatever directly connected offsetting expenses you can, and you go on. And if you're lucky enough, as many nonprofits are, to stumble upon something that really grows and would become substantial if compared to your overall activities, and therefore put your tax-exempt status at risk, you always have the option, as we're going to talk about, of spinning it off into a for-profit subsidiary. Form a for-profit, wholly or partially owned stock corporation or some other form of corporation that we'll talk about later, where you can dump those activities into and then earn that money on an unlimited basis, paying tax on it, and then paying some or all of the after-tax profits back to the nonprofit in the form of dividends or some other way, which are all tax-free to the parent. So like Andrew said, and I've been saying the same thing to clients for years, if you have a great idea, something that's really working, something you think is going to work, don't run away with it, run away from it just because you're going to have to pay some tax on it.
And I would just say for fun, the next time you're out at the Smithsonian with your friends and family and you want to impress them, go through the gift shop, try and figure out which things in the gift shop are related and therefore not subject to UBIT, and which are unrelated. And it's kind of fun. So, ordinarily the Star Wars action figure is unrelated, but then lo and behold, there's a history of the Star Wars cinema and its impact on the air and space industry, and voila, now it's related. So it's always fun. You can impress your friends.
The things that nonprofit tax lawyers do for fun. Huh?
I told you we really enjoyed this. And they've now stolen the punchlines of the rest of the presentation. With that, I'm going to bring us back down to a sad place and talk about things that usually incur UBIT. Advertising income, almost always unrelated business taxable income. Rents received from debt financed property. The flow through of profits from certain controlled entities, so even if you spin it off, we're going to talk a little bit more about that. And income received from the performance of services in exchange for tangible goods. All right. Now, what's excluded from unrelated business taxable income? Again, we love this stuff. And one of the reasons that I love it is because it's complicated and technical and fun. And so here's where I'd like to say, in most recent accounting, I found seven layers of exception to whether or not an organization will be liable for tax. So you start at the very top and you think, all right, I have an organization and it is subject to federal corporate tax. Oh, wait, no, I'm a 501c3, I'm exempt. Oh, wait, I'm doing something that will incur UBIT, so now I'm going to be taxed. Oh, wait, there's an exception to UBIT. No, there's an exception to that exception. There are 7 layers to this. So as Andrew mentioned, if you have come across a great idea or you think you have, don't run away just because you're going to be taxed. There might be an exception to the exception to the exception, which will allow you to conduct the activity and then not incur tax. That 30% on your million might not even be paid without creative accounting.
And lawyers write the tax code to keep lawyers employed. So.
All right. So it's things that are generally excluded from unrelated business taxable income. Note UBTI versus UBIT. It's not a typo. Unrelated business taxable income versus unrelated business income tax. We're talking about the same thing. It will just help you further understand what we're talking about. So let's keep moving along because we're dwelling a little longer than I thought on this stuff. What's a trade or a business? It's what you think of generally. You can look into the code further to get an exact definition, but if you think it's a trade or business, it most likely is. But things that are not a trade or business per this section include substantially all the work involves the activity is performed by volunteers. So if you have volunteer labor, that's great. If it's primarily for the convenience of the organization's members, students, patients, officers, or employees. If the activity is selling merchandise, substantially all of which was donated. For example, think Goodwill. Certain conduct of bingo games, curiously enough. Relating to the distribution of low-cost articles, think a nonprofit sends you a token item to encourage you to donate. That's not engaging in a trade or business. And then exchanging or renting donor or member lists with other charitable organizations. These are some activities that organizations have undertaken that are not trade or business. Substantially related is what matters for our purposes today. Because when we talk about for-profit subsidiaries and when we talk about joint ventures, you want to understand whether or not the activity you're engaging in is considered substantially related to your exempt purpose. Not only will that matter in terms of your liability for unrelated business income tax, but it will also matter in terms of whether or not your exempt purpose will be jeopardized. And that matters when you're structuring your activities because you can shield yourself from that by housing that activity in a different structure. So is it substantially related? The factor here is whether or not it's related to your exempt organization's purpose. And remember, the concern here is, are you engaged in something that would be unfair to a for-profit engaged in the same practice? The need to generate revenue for your nonprofit is not enough. You cannot simply say it's in furtherance of my exempt purpose because we're broke and we need to raise money, as much as I'd like that to be the case.
And 2 quick corollary points there. I don't know how many of you have had discussions with your outside counsel about the discussions that I've had probably hundreds of times analyzing whether an activity is in substantial furtherance of the organization's tax-exempt purposes. It's not black and white. I mean, sometimes it is, but a lot of times it's not. It can be a difficult analysis to do, but a couple of things that are important. First off, a lot of times you can change the facts to make something related that would otherwise be unrelated. And I have some great examples I don't have time to get into now to explain that concept. But also, that's on the facts of the activity, how the activity is structured, how it's carried out. There are lots of ways that you can sometimes turn that unrelated activity into a related one, but also looking to the actual purposes. What are those tax-exempt purposes of the organization? You may be able to restate, redefine, broaden those in a way that, again, takes that activity and makes it related when it was otherwise unrelated. And finally, don't be limited just by the tax-exempt status of your primary entity, because what is unrelated to a 501c3 organization might be substantially related to a 501c6 organization or a C4. So you always have the ability to create one or more affiliated, controlled, tax-exempt organizations in other categories, or maybe even another C3 that has some different purposes to make that activity a related one. So think creatively on both sides, on how you structure the activity and on the tax-exempt organization's purposes and structure itself.
And that is an absolutely perfect segue into our next section, which is to talk about subsidiaries. And so just connect the dots. Why are we telling you all this really exciting UBIT, UBTI stuff? And so the idea is increasingly exempt organizations trying to be more creative about raising revenue, but it goes much beyond that. It's about how to leverage the collective interests of the nonprofit sector and the for-profit sector to achieve meaningful societal change. If anybody's here not to achieve change, if you love the status quo and they're collecting a paycheck and don't have much to offer you other than the lunch and cookies you've already had. But we're here to say, embrace these obstacles and find ways to overcome them and do good. And so exactly as we were just talking about, yeah, there are activities that we can engage in that if we do too much of them, we jeopardize our exempt status. If they get too significant, we'll have tax liability, or even that can jeopardize our tax exempt status. So how do we move forward? We know that the idea of nonprofits being sort of like social R&D and then taking the government to take the scale, that's kind of a broken model. It doesn't work that way anymore. So we have to tap into the rest of society, and a very fruitful place to tap into is the for-profit sector. So how can we leverage what we bring to the table with the activities of the for-profit sector? And it's not just money. If you think it's just money, you're leaving 90% of what they have to offer on the table. So the creation of subsidiaries is a very direct approach. It's like, I've got an activity that I believe in. It doesn't fit in the nonprofit model. Maybe there's some synergies or things that we can leverage that work collectively towards our charitable mission. Maybe they're not. Let's create a for-profit subsidiary. It is completely legal for a nonprofit organization in this country to wholly own a subsidiary. There may be tax implications. There may be consequences that you have to navigate, but it's legal. I want to be very clear. In the private foundation community, you cannot own and control a business. But in the rest of the nonprofit sector, you can. And so nonprofit subsidiaries, you can have for-profit subsidiaries, you can have nonprofit subsidiaries. You can have a C6 or a C4 that is controlled by a C3. Just as you said, that can allow us to leverage what we do things unrelated. It's not particularly complicated to do. In the last nine months, I've created 3. That might be a little aggressive, but it was a long time coming. And I've got one more in the pipeline because it's just like people come to me and like, I've got a problem, I know how to solve that. And I'm talking about for the new venture fund. This is not in private practice where you probably guys create 3 a month. Or more, but so you can create subsidiaries. It's a good way to, and in particular, if there's clarity between the division of what is the commercial activity versus what's the nonprofit activity, it can be fairly straightforward and to do. There are, as I did mention, and we've mentioned, there are nonprofit affiliates, and that's not really the subject of this, but you can definitely have a wide-ranging sort of corporate family structure of different organizations with varying degrees of overlap.
Andrew, just to make clear to everyone, what you guys do is a bit unusual and aggressive to have so many different affiliates and subsidiaries. Not to say you're right in that it's not terribly difficult to form them. Getting exempt organizations approved by the IRS is more challenging than it used to be. The application forms are far more comprehensive and longer and asking for much more detail than they ever used to, with the exception of the new 1023.
Yeah, and I suppose this is sort of one of the don't try this at home. I am an expert in this. I am very creative. I've got a lot of years of experience interacting with the IRS. And again, I'm always driven by the outcome, not the vehicle. And I think one of the things we talked about in planning this, a lot of people, and we'll get to this when we talk about social enterprise. Like, I've heard about these social enterprises, I want one. They're like, why? What are you going to do with it? And I'm like, hey, it's kind of like saying, I want a car. I'm like, great. Well, are you racing? Are you taking the family to the beach? Are you driving cross country?
Are you driving at all?
Are you driving at all? We're going to have to understand where you're trying to go before we know which vehicle to put you in, and that's exactly the same on the subsidiary stuff. So there are lots of things to choose from. S and C corporations. C corporations are what you're most familiar with. These are all the Delaware corporations that are traded on the stock exchange, and they're traditional shareholders. S corporations are corporations that have shareholders. They're generally closely held, but they're disregarded for tax purposes. They're pass-through entities. They're taxable to the shareholders with only single-level taxation. We've also got a lot of other models like the LLC, limited liability company, and one of our favorites, the single-member LLC, which is an LLC that is owned by one sole member. In many cases, it's a very effective structure where a nonprofit is the sole member. It therefore has a fully operational separate legal entity for purposes of liability protection and other advantages. But for tax purposes, it's treated as if the activities and the taxes and the income are all for the parent. Why would you want to do this? For example, I have an activity that isn't particularly risky, but perhaps it has something, there's some liability associated. Maybe it's going to own property that it's going to exploit in furtherance of kind of a mutual goal of the organization. And owning land is one of the riskiest things you can do that seems not risky at all, right? Because if you're in the chain of title, any environmental liability that ever attached to it is everybody who ever has had their name on that title is jointly and severally liable, even if you only held it for 1 hour. So I'm like, well, hey, this is a really good project for us to have. I don't want to jeopardize all of the assets of my exempt status. If we're going to run this and we're going to own this land, let's set up a single member LLC where I gain some liability protection from holding that asset, but I can still have effective control over how we exploit it and use it in furtherance of collective goals of the nonprofit and the for-profit.
And just to make sure everyone understands the single member LLC, because it is a model that we've used more and more and more in recent years, use it for a lot of environmental groups that are in the business of holding and owning land, and lots of other activities where there's risk attached to it. But when we say disregarded, we mean for federal tax purposes and state tax, corporate income tax purposes, it's as if it doesn't exist. So everything just gets rolled up into the same Form 990 for the tax-exempt organization. Obviously, these are going to be activities that are substantially in furtherance of the organization's purpose and mission. If it was an unrelated activity, you'd be doing it through some sort of a taxable subsidiary. But it is a very common structure. But one thing to keep in mind, while there is great value to setting up these sorts of entities and other sorts of subsidiaries and affiliates, and we do it all the time, and some of the most successful nonprofits that we work with have very complex structures. Don't think that it's just a piece of cake, that it's just incorporating something, maybe getting exempt status and filing a form with the IRS and the state each year. It's a lot more to that, and the governance, maintaining these separate governance structures, and along with all the corporate and tax and accounting formalities, it's a lot of work.
Yeah.
Ask the CFO and the controller of organizations that have multiple entities. They're the ones that take the brunt of it, all the internal cost allocation and timesheets and affiliation agreements and intercompany transfers, all of the stuff that has to happen, the separate board meetings and whatnot. It is a lot of work, and so we always advise clients, don't rush into this unless there's a very good reason, you've thought it through, and the benefits are going to outweigh the burdens. And oftentimes they do, but we've also seen many organizations jump into this that really didn't need to, or at least not yet.
Yeah.
And I love the flexibility that a single member LLC will provide you. So as Jeff mentioned, there's federal tax purposes. You create this, you have an activity, and you check the box. But if the activity becomes more than an insubstantial amount, where you'd incur or it becomes so commercial that it would jeopardize your tax exempt status, you can uncheck that and then say, you know what, you don't have to form a separate entity. You can just use that structure still, and it will be treated as a corporation for tax purposes. So there's a tremendous amount of flexibility with using the single member LLC.
And so I just want to sort of tee up the social enterprise legal structures, but we'll leave it for later. But I think one of the problems that came up historically is when we had nonprofits and for-profits working together. On the nonprofit side, you have to make the argument like, hey, everything we're doing is exclusively, wink, wink, for charitable purposes. And then you've got for-profit saying, hey, everything we do is exclusively to make a profit. And there's actually case law that slaps the hands of corporations that attempted to forego some of their profits for the good of society. That is not their job. To some extent, it was just sloppy window dressing on that, but we do generally, as society, accept that there is some social good that for-profits can do, but there's always this tension: maximize profits, only further charitable purposes. And what we'll talk about later is these hybrid entities that come out and accepted that there's some trade-off between those things, even outside of the traditional corporate context, and we'll cover that later. But that really does arise from this effort to try and work together. And just to sort of talk about exactly what Jeff was saying about, it's not as easy as just filling out a sheet of paper. Us tax nerds and lawyers, oh, that was easy, that was fun. There is a lot of work that goes into maintaining separate entities. You need to really observe the corporate formalities. You have to have separate board meetings. You have to have separate legal entities. You can't just run them along. You really have to observe all the different aspects that make them separate. If you're sharing resources, that's fabulous. We manage a lot of organizations that share resources. You have to document it meticulously. You have to be very careful that everybody's paying their fair share. You can't just kind of lick your finger, put it in the wind, and be like, it's about a 30-70 split. You really have to pay attention to it. And sometimes it's really cost ineffective to do that. I used to have a code I had to punch in. Remember landlines and long distance charges? Not all of you may know that. You used to make a phone call and you have to enter it, and then some poor schlub would come around to my office once a month and be like, you owe me 75 cents in long distance fees for personal calls. I'm like, you just spent $100 in personnel time collecting 75 cents for me. So I say that because you can be penny wise and pound foolish here, and you really do have to observe all these things. If you're doing all this to save yourself $5,000 in unrelated business income tax, stop it. You're throwing away money. So don't be penny wise and pound foolish.
One quick point that a lot of people, when they hear separate boards, separate entities, they automatically think losing control. And control is probably the number one issue that we deal with anytime we're talking about subsidiaries and affiliates. That's what every nonprofit is concerned about. That's what every parent entity is concerned about. You don't want to take your valuable program, initiative, time, money, and put it into some entity that's going to go away and run away on its own and go in a different direction. So how you establish control is very important. And while it is important to have separate boards, to have at least some separate board members on those separate boards, there are many ways that we utilize to exercise some pretty strict control: the ability to appoint and remove all directors, the ability to approve any proposed amendments to articles of incorporation and bylaws, the ability to approve even budgets or to approve major decisions, and certainly to approve mergers and consolidations and large asset transfers. There's lots of handcuffs you can put on both tax-exempt and taxable subsidiaries and affiliates. So don't think just because you hear separate boards that you means loss of control.
Yeah. One of the sharing resources I just want to make a particular point on is intellectual property is really important to deal with early on. Intellectual property is worthless when you start, and it becomes exponentially more expensive as you go down the road. If you don't have a plan on how to divvy up intellectual property ownership, this is patents, trademarks, goodwill, names, logos, inventions, software, know-how, all these things. You really have to figure out who's going to own what. I think in particular when you think about blending a nonprofit and a for-profit activity, because of the conversation about UBIT and the fact that rents and royalties and licensing are generally 5 levels exempt from unrelated business income tax, it can be a very effective strategy to have the C3 charitable entity own intellectual property. It can then earn revenue back from licensing. And if at some point you want to spin out the for-profit activity, separate it from the nonprofit activity, there is an opportunity for the for-profit entity to buy the intellectual property, make a significant infusion of capital into the nonprofit, which then both justifies its participation in the activity and provides it revenue moving forward. You're probably very familiar with hospital conversions where a for-profit hospital wants to take over a nonprofit hospital. There's a transfer of intellectual property, a massive infusion of capital that leaves the nonprofit able to go on and continue to fulfill its mission long term, and you've got that transfer of intellectual property, and it's a really good way to sort of navigate between what's this value and what's that. So can't get into too much detail on it, but I did want to mention that's a really critical thing to think about in advance.
And while we're talking about capital, we skipped this a little bit, but if you're going to form a for-profit subsidiary of a nonprofit, you must adequately capitalize that as the parent of that corporation. Because if you're creating this for-profit subsidiary to shield your tax-exempt parent from liability, that liability shield will be pierced if you haven't adequately capitalized it, because it appears as though you aren't actually operating two separate corporate entities.
Yep, that's excellent. And so again, just to circle back on what Jeff just said, there's lots of other considerations that go into whether to create a subsidiary or not. The administrative costs, the prudent, whether or not it's a prudent investment. Again, you are taking assets of the nonprofit. You are investing them in a for-profit enterprise. Is that a prudent use of the resources? What's the risk profile of your organization? How much of your assets have you sunk into this activity? And if it goes belly up, have you ruined the organization? Again, why don't you learn to swim before you go off the high dive, not to mention into the deep end? So be very thoughtful about that. And then there's obviously considerations about securities law and, like I said, exit strategies. We can't go into all of those, but it's not just like, hey, I heard this in a session, we're going to do it, woohoo. You're going to have to work with counsel and figure out what all the ins and outs are, and work with your board to see what their risk tolerance is. So that's the subsidiary approach, which is, hey, let's create. But there's also something that's an in-between. It's like, hey, let's not necessarily create our own for-profit subsidiary. What if we enter into a relationship with an existing for-profit, where, as I said, not necessarily an existing for-profit, but that's a simplified version, but where we bring what we have to the table and they bring what they have to the table, and how can we partner together? So do you want to?
And before we jump into that, do we maybe want to brainstorm a few examples so everyone has an idea what we're talking about? I'll just rattle off a few ones that we've worked on. And so a lot of times a nonprofit is engaged in certain activities, and it's carrying them out in a way that's in furtherance of its nonprofit tax-exempt purposes. But there also are for-profits in your same space who are doing some of the same things, perhaps in a different way, in a different structure, different profit motive, but are doing a lot of the same things. And a lot of times an opportunity will come along for a partnership between the nonprofit and the for-profit. It could be a trade show, it could be a publication, it could be an event, it could be some online education or training program. It could be something relating to certification or standard setting. We've done all of these, and the great thing is that when you're deciding whether to partner up or joint venture with a for-profit, you may get access to much greater technology and expertise and know-how, market share, relationships and connections, and just overall money. And it may help the nonprofit to further its exempt purposes. It may also help the nonprofit to make a lot more money. And so we're going to talk about, the analysis of, is it substantially furthering your exempt purposes? Is it going to generate tax-free revenue to your organization? But you really need to think creatively. This program, I don't want everyone to think, this is just about, new forms of, social enterprise and new forms of hybrid nonprofit, for-profit corporations. This kind of stuff can and should, this kind of thinking should happen every day in every type of nonprofit organization that's represented here, because there are great opportunities for all of you. You just need to understand the rules of the road before you jump in.
Yeah, and one of my favorite examples, just because I think it's this really beautiful synergy between the nonprofit and the for-profit, I was working with an organization that its goal is to bridge the digital divide and bring technology in particular to significantly underserved communities. And there was a rural community in Indian country, and the people laying fiber optic cable got to the edge of Indian country, and for a variety of reasons, including sovereignty questions, frankly, the ability to pay, there's no commercial market here, we're done. And the nonprofit was able, through a joint venture agreement with them, say, listen, we've got a deal for you. You're going to lay fiber through Indian country, bringing state-of-the-art digital access to this entire community, and you're going to give them access for free because we're going to pay for everything. And what that gets you is by going through Indian country, you're going to get to the profitable market on the other side of Indian country at a fraction of the cost. And they're like, deal. And so we got fiber into that community at pennies on the dollar what they would have been able to do working independently. The for-profit was able to get something out of it because they got access to the market on the other side and cut through a whole lot of bureaucracy in terms of, working with the tribal government to get it through. It was clearly win-win, and the way we structured the deal made absolutely certain that what the for-profit got out of it was more than paid for in terms of what the benefit society was, and for the nonprofit bridging that digital divide. I just think it's a really kind of crisp idea of like the win-win there. Again, there's a lot of work that went into what exactly are we getting. Are we cracking open, the safe, and you're taking all the doubloons? No, we made sure we got something out of it in return. But I think that's a pretty good example of how this can work. And again, there was a company out there that was doing this work. There was a nonprofit that was doing work. They found common ground and they worked together. And we'll talk about the structure later.
And that finding common ground allows your nonprofit to even better serve your mission, because I'm sure that the nonprofit in that example did not have experience with fiber optics. So you're better able to serve your constituents by entering into these agreements, again, as long as you're not going to jeopardize your tax-exempt status. So with that, let's take a look at some of the structures that are available. One second, one too far. Okay. What? Okay. They're in your slides. It can take a variety of forms, just as we talked about with the subsidiaries. You can have a general partnership, a limited partnership, an LLC. You see again that single member LLC is an option. And then another organization, one of these new hybrid structures that we're calling social enterprise structures. However, good point here is that you may not have to have a separate legal structure to operate your joint venture.
Yeah, and as you say, I think a lot of people get caught up in got to do all these complicated things. What I liked about my example is it was simply a contract. There's a contractual relationship that created the joint venture. It's not a simple contract, but it was a contract nonetheless. You don't necessarily need all the expenses, separate governance stuff. You can actually enter into these things in a variety of different ways. It's a little bit scary, and I just want to be clear that this is supposed to be positive and encouraging, and I don't want you to walk away and be like, oh my God, every time I sign a contract, I'm creating a joint venture. That's not true. It can be done in a variety of ways that doesn't necessarily include a separate legal structure.
Well, and let's talk about that for a second, because we just had a question from the webinar. When your nonprofit contracts with another company to provide some services, it could be a management company, it could be a consultant, it could be someone who's operating a program for you, or someone could be going out and marketing your products and services. You may compensate them on a flat fee per month. You may give them a percentage of sales, of gross sales. These are arrangements. These are very common arrangements that don't carry with them the liability risk and the tax complications that a true joint venture does. And in many instances, this is going to work fine because you're not the legal definition of a joint venture is when you're sharing in the profits and the losses. That you both have some skin in the game, and that's where you see in a lot of contracts, this shall not constitute a partnership or joint venture because you're trying to avoid everything that goes along with that. And if you don't want to go down this path, then don't. And just structure it in that manner, and that's going to work for a lot of you. But if, in like your example, Andrew, if that's the only way to really make something happen, or you have some new initiative where you really do need to share in the profits and the losses in order to make the business economics of the deal work, then that's what we're talking about. That's what all of this is about. Yeah,
and a classic not a joint venture is like the affinity card program where, you literally have no skin in the game. If it works and the credit card company makes a lot of money, they send you all that money. If it doesn't, if they run all these advertisements and stamp your name and it never makes them a penny, you don't pay a thing. That's not a joint venture because you have no skin in the game. You just get the proceeds. To some extent, maybe you can argue there's some risk to your brand, but I think that's minimal. But yeah, that's exactly. You have to share equally, not equally, but there has to be some assignment of both the risk and the reward.
And in a joint venture, remember, we're not talking about you can only enter joint ventures with for-profits. Remember, this is a vehicle you can use for any sort of partnership with another entity. But for our purposes, when you are entering into a joint venture with a for-profit, there's a couple of things you're going to want to keep in mind. First, that your activities are substantially related to your exempt purpose. Remember, we do not want to start to trigger concerns about whether or not there's no public benefit in the operation of your organization. That's exclusively in furtherance of your charitable, educational, et cetera purpose, and that the benefits to the partner, the for-profit partner, are incidental to the public purposes served by the partnership. So the goal here isn't, hey, let's form a joint venture, and you're going to make a ton of money. That cannot be the primary purpose of your joint venture for the for-profit.
Yeah, and I'd say you will spend a lot of time wrestling over sort of the structure and that sort of thing. You should spend an equal amount of time, in most cases, wrestling over sort of that charitability question.
And that's what this next slide is all about. We're back to private benefit. We want to examine any amount of private inurement. Remember, this is the one that is absolutely prohibited under the code. So then no private inurement may exist. You're jeopardizing your tax-exempt status if that happens. From the federal tax income purposes, you're thinking first about your tax-exempt status. Are you jeopardizing that? And then will it result in unrelated business income tax? Generally, if you retain control over the activities, you won't have too many concerns in terms of whether or not the joint venture is going to jeopardize your status. But it depends on the scope of the activities conducted. Let's go. Exercising
Carrie,
control.
just to clarify, we're talking about control, meaning majority decision-making control we're going to get into here. Just dialing back, the first thing you said was the activities have to be in furtherance of your exempt purposes. So what we're saying is even if this joint venture between a nonprofit and for-profit is in furtherance of your tax-exempt purposes, and there's no question about that, that's not enough if you want to ensure, A, that your exempt status is protected, and B, that you don't generate unrelated business income. We're going to talk about that now. But sometimes you never get to the point where the activities are in furtherance of your exempt purposes. So getting back to Andrew's affinity credit card example, that I can see lots of representatives in the room that have affinity credit card deals between their nonprofits and for-profits. It's a classic endorsement deal. If you were to do a true joint venture with a bank or a credit card marketing company or something like that, and you create some new card that's going to be marketed to your members and others, generally speaking, that's not going to be substantially in furtherance of your exempt purposes. So even if you maintain majority control over the key decision-making, it's not going to matter. It's still going to be an unrelated activity. It might still be worth doing through through directly or through a for-profit subsidiary or something like that, but it's not going to be in furtherance. So what we're talking about is you first meet that first test that is substantially in furtherance, and then we get into the control issue.
Yeah. And just in terms of control, I think some of the most illustrative examples of the control really come out of the hospital joint venture context, where you have a nonprofit and a for-profit, and they're obviously working together to bring health care and serve the community. And the class examples, and there's just two examples, and they come out from the IRS at about the same time. And there's just one where the nonprofit really controls the delivery of service, the community standard of providing care, and they're really calling all the shots. And there's an almost parallel structure where the nonprofit no longer has a deciding voice. There's something specific in the good example where it says, this organization will forego profits if necessary to continue to serve the needs of the community, and the bad example didn't. And they just provided two examples that the IRS was able to look and be like, because the nonprofit joint venturer does not have sufficient control of the activities, this is a problem. You have to retain control over the activities of the joint venture to ensure that it will continue to further charitable purposes, to be consistent with your mission, and that sort of thing. So in my fiber optic situation, in that case, the company laying was simply a contractor, totally subject to the discretion control in that particular aspect of the project, where it was going to go, how it was going to be laid, how the rates were going to be established. They're just doing the work. Another example that I like was there was a research project and had to do with the development of a drug to serve a disease that really has no market. It's not a marketable drug. There's just never going to be marketable. There just aren't enough people in the world who have it for it to be profitable. They controlled all of the research and development to come up with a drug to cure that or treat it, not cure, but to treat it they had the scientist, the nonprofit, but it was a co-venture with a for-profit pharmaceutical company who had all the labs and the equipment, and they also got to retain some of the discoveries that could then be leveraged for other drugs and that sort of thing, and the way that was structured. But again, throughout the entire project as it related to the development of this particular drug, the nonprofit and its scientists and its experts retained 100% control, 90% control. It doesn't have to be that high, but it has to be clear control that has to be retained. And again, what is the return on investment? What are you getting back out of it?
So some other considerations that I just want to go through very quickly here so we can get to social enterprise structures are other options to explore when you're operating a profitable business. One of the examples that I enjoy is when you're furthering the exempt purpose, you can operate a joint venture in furtherance of your exempt purpose, such as a job training program. So if your nonprofit exists to help former convicts get marketable skills, you can operate, say, a set of franchise restaurants and generate substantial profits from that activity when you have the employees serving as your constituents for your nonprofit, which is very interesting and exciting because you're able to give them on-the-job training and generate revenue to support that program at the same time. However, all transactions with exempt organizations, there's a couple of things you need to keep in mind. They need to be done at a fair market value. Due diligence into that value needs to be conducted, and it needs to be properly documented. And our final discussion on unrelated business income.
Yeah, and I was just going to say the other thing I was going to say is it's one thing to have it all set up on paper and it reads all nice and pretty, but then you go and look at how things are actually being run. So we got to marry up what it looks like on paper and the reality of the world out there. And so again, we circle back to the incredibly interesting topic of unrelated business income. And again, regardless of the activity and the structure we're looking at, you have to constantly come back and say, are these related? And now we're looking at the nonprofit. We've got this activity. It's been successful. The question is it related? If it's an unrelated activity, you have to go and then say, is the activity substantial? If it's related, you're not going to be subject to unrelated business income tax. If it isn't related and it's not substantial, you're still not subject to it. But if it's unrelated and it's substantial, you need to make sure that you're working with your tax counsel and you're properly documenting and recording it and voluntarily paying your liability until they come and collect it.
And or revoke your status. So remember, if it becomes more than insubstantial, you might have a problem.
And we should have added here that it's not just related or unrelated. Carrie had an earlier slide about all of the different exceptions and exclusions from unrelated business income. So there are lots of different ones. Most common that we see in the nonprofit world, in the charitable and the association world, the royalty exception, the qualified corporate sponsorship exception, the qualified convention and trade show exception, the exception for dividends, certain rents, interest, annuities. These are all various buckets of income that if you fit your income and the related activities into those buckets, then it's going to be tax-free income. And we have worked with many very successful, profitable nonprofit organizations to, for instance, turn what would otherwise be taxable advertising income into tax-free corporate sponsorship income, or perhaps even into royalty income, or some combination of both. So think creatively and aggressively, but smartly, to structure your activities and your income accordingly.
And I think to some extent the point about all of this is there are no silver bullets. There's no magic solution to all these different things. It's like a seven-headed hydra. If you lose sight of one of the heads, it's going to bite you. So just make sure you're constantly looking around. Where's the UBIT head? All right, there it is. Got it. And you can navigate it appropriately.
That makes it sound even scarier than I made it sound.
A little Game of Thrones in there, right?
All right.
There will be hydras. So
let's get to the social enterprise part of our presentation today, and we're going to talk a little bit about what this movement is and the structures in it. I say it's a controversial part of our presentation because particularly sitting in the nonprofit space, you'll hear nonprofiters say, we've been doing this for years, we're mission driven, what are you talking about? What we're getting at here with the social enterprise stuff is the people that believe that there is a dichotomy between the for-profit and the nonprofit worlds. So you have for-profits who are in furtherance of their bottom line, that being one bottom line, their profits, compared to nonprofits who are furthering some sort of mission. The people who are in this movement believe that social enterprise is really the marriage of those two things, using business practices in furtherance of some sort of mission, social or environmental. So that's the idea. There are multiple definitions of what is a social enterprise or what is a social entrepreneur, so I'm not even going to pontificate on that. If you'd like to read about it, just Google social entrepreneur. So let's talk a little bit about this movement. Some actually argue that it began with Hull House. I don't know if you know this, but Hull House in the late 1800s actually operated a night school for adults, kindergarten classes, clubs for older children, a public kitchen where they sold food, art galleries, coffee houses, a gymnasium, coal cooperative, I'm not entirely sure what that is, a girls' club, swimming pool, bookbindery, among others. So some people mark this as the beginning of social enterprise because there they were providing skills training to solve the social problem of poverty, among others. Modern day estimates think that it starts in the 1970s, 1980s. And social entrepreneurs work under any type of mission. Some organizations that you'll commonly see in the social enterprise space are listed here. This is not exclusive. There are many organizations working to support and develop social enterprises today. These are some of the big ones. The thing that we're going to cover today is what are these new social enterprise legal structures? So is this a new area of law is the controversial question. This map provided by Casper down at Georgia is a good representation of where states have adopted some sort of new corporate form to allow entities to marry these two ideas of mission and profit-driven. There's this idea that if you are in fact solving a social problem, that you might be doing it in a way that is more akin to a for-profit operation than a nonprofit operation. I don't agree with that. But that is what it said. So this is a good representation of how these entity types are flourishing in the corporate statutes of the states in the U.S.
Yeah, and I would just say, I mean, Jeff said something earlier, like, if the facts are bad, change the facts. I think I'm a little bit cynical about this. I really believe in the goal and the outcome. But a lot of this stems from a Delaware court case where there was a shareholder fight about what the role of the corporation was. And the corporation was engaging in some activities that were purely social benefit. And they're saying, no, we're doing this to give back to society. This is because we're doing well, we should do well by the people who are helping us do well. And the other shareholder said, that's none of your damn business. Give me my money. If I want to do good stuff with it, I'll do good stuff with it. That's not a decision for the corporation to make. And the court agreed with him and said, it's not your job to decide what to do with his money. It's his job. And if he wants to be greedy and selfish and keep it all for himself, God bless him. And if he wants to give it back to society, that's his choice. It's not your job at the corporate level. Contrast that with what is more common these days, which is for corporations to say, by doing well, it's better for the bottom line. By being more respectful of the communities we operate in, by understanding our supply chain and that investments in international foreign trade and the ability of workers to earn a living wage, we're not just doing good for society, we're doing good for the company. There's no argument. There's no conversation about whether or not you have to trade off. It's all baked into the same pie. So I'd say to some extent this is a necessary response to sort of a silly fight between a couple of people who had way too much money and were fighting through a company about it. But at the end of the day, it is really kind of this push-pull. How do we talk about the work we do in the for-profit sector and the nonprofit sector? And to some extent, if it does nothing else, then facilitate more candid and thoughtful conversations. I think it's a good thing. Whether or not it's new law or really a new structure, I don't think it's particularly important as long as we're having the right conversations about moving this all forward. So sorry that was a little preachy.
And you'll see that in large corporations that have corporate social responsibility programs. It is becoming more common for large organizations to believe what Andrew was just discussing, which is, hey, we do need to do good while we earn our profit. And so in some ways you could argue that these new legal structures are duplicative of that. Regardless, let's talk about a couple of them. The first we saw on the scene was the L3C. And L3C is very similar to an LLC, but it must be organized and operated in furtherance of one or more charitable or educational exempt purposes. This has started as a for-profit primarily with the hopes that it would be a vehicle to receive program-related investments from private foundations. That explosion of dollars from private foundations to these types of entities has not happened. And in fact, a couple of states, actually just one at this point that I know of, although correct me if I'm wrong, has revoked this corporate structure. North Carolina last year decided, hey, we don't actually need an L3C. We're taking it off our books even though we had it. So you'll see that in this previous slide's map. I think just North Carolina is the one so far.
Yeah, and I think I worked a lot on the Hill when these were new to talk about sort of like, does this provide an opportunity to say, listen, because we're doing a PRI through this structure, are there any shortcuts we can take in terms of the very complicated and bureaucratic process of approving these joint venture relationships between a non-profit private foundation and a for-profit in some form or another? And basically what the answer that came back was the IRS just couldn't ever get comfortable with it. And so the value of creating an L3C was never fully realized, because if you can take some shortcuts, and I don't mean, shortchanging the charitable activity, but if there's ways that the structure you choose helps you get through the IRS oversight and the determination of charitability more efficiently, maybe the trade-off is worth it. But without that sort of second shoe falling, you sort of break any of the value over other more traditional models. And I think that's why you're seeing states retreat from it.
Exactly. And so I'm not going to cover some of these slides in depth so that we can wrap up here on time. But there are a couple of criticisms on the L3C that follow through with the other structures that I'm going to discuss briefly. Number one, that it's unnecessary. There's no need to create a separate structure. The LLC does this perfectly fine. It's misleading to the public. It's actually a for-profit, and it's acting like a nonprofit, among other criticisms. So let's talk about the benefit corporation, because I'm sure a bunch of you are curious about what this is. Benefit corporation, B corporation. Let's start with benefit corporation. This is a new legal structure, the most popular of the quote-unquote hybrid structures or social enterprise structures, that basically bakes into its corporate foundation some sort of mission. It requires officers and directors to consider non-financial interests other than just the profit-making motive that Andrew discussed in terms of that Delaware case. It requires a fiduciary duty redefinition, as I mentioned, and annual reporting requirements. Let's keep going. The purposes that you can put into your benefit corporation vary. It can be a general public benefit as defined in the corporate statutes, or you can put in a specific public benefit. And there, think along the lines of you creating a mission statement for your nonprofit organization. It can be very specific or it can be general. The key here is to provide a certain level of transparency in your reporting, though, and so you want to make sure that when you have to file annual reports that you are actually meeting some sort of measurable impact with your the mission that you've put into your corporate purpose. The benefits reports, notably, are delivered to a couple of key parties: shareholders, the public, and in some states, the Secretary of State. Some states require a third-party standard for these evaluations. Notably, Delaware does not. So let's talk about B Corps, because, just get variations. Let's talk about B Corps for a second. I'm sure a lot of you have heard about B Corps. It's different than a benefit corporation. A B Corp is an organization that has been certified as such by an organization called B Labs, which, interestingly enough, is a tax-exempt 501c3 nonprofit. So this is the nonprofit behind B Corp status. Not only do they exist to certify, which they earn money from organizations to do, but they also are promulgating or assisting in the promulgation of a lot of the laws to adopt the benefit corporation statutes. So they have their hands in this whole area of social enterprise structures. Certification requires a number of things and can be quite an exhaustive process. Locally, Arabella is B Corp certified, RAFA, Busboys and Poets. Think nationally, you're thinking King Arthur Flour, Patagonia, Greyston Bakery, Clean Canteen, Ben & Jerry's, Dansko, and The Honest Company are some good examples that have pursued B Corp certification. This does not mean that they have necessarily elected to use one of the social enterprise legal structures. It simply means they've received certification. And there, if you're interested, on their website, B Lab's website, you can learn more about what is required in that certification.
Yeah, so Arabella is an LLC that is also a B Corp. So it's not a benefit corporation, it's a B Corp. It meets the standards, and there were lots of reasons why we, in our infinite wisdom, thought that was really beneficial for the enterprise.
Now this we're going to kind of gloss over quickly because we run out of time. There have been some variations to benefit corporation statutes. Most notably, our leader in corporate law, Delaware, enacted one of these statutes in 2013 but amended what had been promulgated by B Labs. To require, it's a slightly different approach. Here, your specific benefit can override a general benefit. No third-party standard is needed, as I mentioned before. And the annual benefit report only goes to shareholders. No requirement that it be made to public or given to stakeholders. All right. So another version of these forms, where you first saw in California, is a social purpose corporation. The states where it is now is listed here, but it can be broadly or narrowly defined and or could be a general purpose. There's no requirement for use of a third-party standard here for measuring its impact, which is notable. Now, why use these? So when you're thinking about structuring as a subsidiary or a joint venture, that's what we've discussed so far. How can you use one of these new structures? You can use it as a for-profit subsidiary. A lot of people argue that this provides nothing new to the corporate law existing as it does now, but it does signal to people that you have a mission with your organization other than just profit. So it's a great marketing device. So if you are starting a for-profit subsidiary and you elect a benefit corporation structure, it can say to the public a certain message other than just a for-profit structure. Now, I want to get into, before I run out of time, a couple of considerations with these and some criticisms. There is no case law construing these statutory provisions yet, so this is very new. Potential investors might be confused about what this structure means. So wait a second, I invest in this, but I have to share an interest with some other interest, something about fish or wildlife or, children getting something to eat or something like that. So there is investor confusion there. I think we'll just gloss over those and get to questions.
Well, and I was just going to say, I heard that if you create a social benefit corporation, that's really hard money to raise, just starts falling off of trees, and all you have to do is just pick it up and you're set,
hoping he wouldn't say this. So this is one of the things that people practicing in this area have seen a lot. You think, I'm running this nonprofit, I have a great mission, I'm doing amazing work, but you know what? Donations in a recession are really hard to come by. I'm going to start a for-profit, but I'm so mission-driven that I don't want it to look like I'm evil. I've actually heard that from people. So I want to start a social enterprise, and then I can get investors, right? Unfortunately, no. So the background to all of the things I just covered is that these are interesting structures. It's an interesting development of corporate law. Whether or not it's an academic exercise has yet to be seen, because Maryland, having started this first structure, the benefit structure, has not seen an explosion of conversions or incorporations of these structures. In fact, last count, it was still under 100. So these are interesting. They provide certain opportunities for organizations using them, but they haven't been the gold pot that everyone's hoping they'll be.
Yeah, and I would just say, if you don't know, if you can't put your finger on exactly the problem you're trying to solve with a particular model, you don't know what you're doing.
And if you don't have a business plan, you're just starting one of these is not going to help you unless you have something realistic that you're going to
And
take.
Perhaps maybe the most telling thing is a comment Andrew made a few minutes ago, which is that while there have been some notable developments, as Carrie highlighted, at the state law level, the state corporate law level, the IRS hasn't been playing this game. They haven't gone along and recognized any of these models as tax exempt. A lot of folks would like them to, but unless and until they do, I've always thought, these things are always going to have some limited utility. Not to say that there's not some value and some utility in certain circumstances. It's more, to me, the benefit to the for-profit than the nonprofit, but that may provide opportunities for partnerships or joint ventures that might not otherwise exist. And so to me, some of the most interesting thinking that we do and work that we do in this area is when you're taking, say, a for-profit that wants to partner up with a nonprofit in a certain way, really does have some social or charitable mission or goal, but they're worried about delivering to their shareholders. If they can create some sort of subsidiary entity that is one of these hybrid models, and that entity can then partner up with a nonprofit, that may open up opportunities that wouldn't otherwise exist.
And we're still 2 levels away from the IRS giving us any sort of go-ahead with these structures, because we still need to figure out whether or not, see if the states would allow them to be tax exempt, and or how the states are going to regulate them. Charity regulators in states are still considering, wait, if it's mission-driven, do we need to be regulating them like we're regulating charities, because they're kind of getting donations, but they're not legally getting donations? So we're still a couple levels away from even the IRS, unfortunately.
Yeah, I think that's the really key question, is how do you navigate the fiduciary duties of the boards and the trustees of these organizations, and how do you balance off those things, the profit interest and the societal benefit interest. And if they're in conflict and there's a dispute and the board's divided, how are you going to come in and rule on a court case on who wins and who loses? And that everyone's sort of waiting for that.
Okay. I've got about 1 minute left. Carrie or Andrew, any closing comments, thoughts, words of wisdom, interesting quotes,
Again,
stories, jokes?
My thing, I think all of this stuff is really interesting, but you have to understand where you're trying to get to. I have a twin sister. We fight all the time. Surprise. And a lot of the time what we're fighting about is she's a significantly controlling person, almost as controlling as I am. And I'm like, you just got to decide, do you care how we get there or where we get? And if you care about where we get, I can help you figure out how to get there. If you care more about the path we take than the destination, I can't help you. And I think that's true. That translates to this. If all you're focused on is what vehicle you're going to use and the path you're going to take, you're probably not going to get to your destination. You have to know what you're trying to do, what you're trying to accomplish, where you're trying to go, what problem you're trying to solve, or all of this just becomes picking doors randomly and seeing where you end up.
Great comment. All right. Thank you, everyone, for joining us. Hope to see you back here next month for our program. Thank you very much to Carrie and Andrew for a terrific job. And
thank you.
Have a good rest of your day.